Good morning, everyone. Welcome to another episode of the Three Consulting Amigos. Today, we're going to have Ed talk about a topic that for many of us might be kind of boring, but what I appreciate about Ed, he digs into things that can have a dramatic impact on your bottom line and how you put together your financials. So I'm excited to learn more about this, and I think for you as a business person, this could be a major shift for you. So with that, Ed, tell us a little bit more about leasing accounting and how it's going to impact small business.
Thank you, Ray. Appreciate the introduction. Today, we're going to be talking about the accounting change for operating leases. And this is a dramatic change to the way a small business accounts for their activities. And I got a feeling that a lot of the small business owners that are going to be watching this little segment are going to not understand. Probably that might be the first time they hear about this, but they're expected to report this way this year. And everybody I talk to when it comes to small businesses, and I start talking about this because I've been talking about this for 3 years, that they need to get prepared for this. It's always a surprise, and it's always shocking to them that they have to do this. Why do they have to do this? Well, this program is going to talk a little bit about some of those questions, and hopefully people will better understand what's expected of them. So moving along here, this year, 2022, small businesses are going to have to account for their operating leases on their balance sheet as a right to use asset and as a liability. And prior to this pronouncement, liabilities for leases were not on the balance sheet for the most part. So when you think about Federal Express and you think about how big of an operation they are, their leased airplanes were not on the balance sheet. And that's millions and millions of dollars of liability there that weren't shown anywhere on the balance sheet. Well, 2 years ago, the bigger companies that are listed with the stock exchanges had to go to this new accounting pronouncement. But it's so complicated and it's got so many ramifications and it's so hard to understand. The AICPA has allowed 2 more years for the smaller companies to comply with this new standard. So this is the year. We can't postpone it anymore. And I bet you if I did a survey right now of the small companies in our region, probably half of them have no idea this new pronouncement is on.
At the very least, I would say.
Yeah, exactly. I think both Ron and I are saying this is new.
Well, it's not new. It's been in development since 2009. And it's taken that long for them to come up with something that everybody agrees with to report these leases. A lot of revisions, a lot of changes, and it's primarily for the investment community. So right now, I'm working with a small company that we're going to be putting $13 million worth of lease liabilities and lease assets on their balance sheet, which is a big number. It's probably a total of 30 leases. That's a big change in the way they operate. And it also impacts the way you expense them too, because in the past, when you made a payment, you would expense the lease payment. But under these new pronouncements, you have to take a 5-year average, whatever the lease term is, and you add up all the payments and divide by the number of months, and that's the amount of expense that you should be reporting on your income statement. So a lot of companies they've been understating that expense. And when they convert over to this policy or this new standard, they're gonna have higher expenses that they're gonna have to account for on an annual basis. So that's pretty much what we're going to be talking about, gents. And I guess really the first question is, why should small companies comply? Well, first of all, if you're audited or if you have reviewed financial statements, if you're that big, you need to comply. It's going to be a requirement that the auditors are going to expect you to comply with this new standard. GAAP reporting is expected by banks and investors. So if you're a small company, you should be reporting in accordance to GAAP. And I think most companies strive to be GAAP compliant. But this is going to be a significant change in the way they think. In the past, it's primarily been, well, you need to be accrual accounting rather than cash basis accounting. Well, this is completely much more sophisticated than that, and a big change in the way financial statements are prepared. I think another reason is that if you want to become a legitimate business and you want to sell your business eventually, you really need to follow GAAP. People expect GAAP if they're going to buy your company. They want to see how your statements look and how profitable you are. So
can I make an observation here? You know, this 13 million you found for this company, I mean, that's a big deal. And there's it seems to me there's some huge advantages to this. Am I accurate in that?
it's a big deal. It's very complicated. We're going to get into that in a little bit. But the bottom line is that it's going to blow out every covenant you have with any banks for lines of credit or any type of loan agreements that you have. So
Yeah, it kind of makes me think and wonder about the whole issue of racial analysis, the kind of things that we used to do. We've set our thinking on certain ratios for certain measures on the balance sheet, for instance. And bankers are obviously going to have to make this adjustment. But you've got things like Moody's and all of these standard companies that have done racial analysis over the year, primarily for the financial industry, but also for and investors. Now all the ratios are completely wrong.
that's right.
So this really represents a paradigm shift from where we've been for, well, the 50 years that I've been in business and where we're going now, because you're just not thinking the same in terms of your your debt to equity ratios, and it goes on and on and on and on. So now you're going to have most companies who have leases are going to have a debt which is many times potentially higher than it was previously. And as a result, their debt to equity ratios are going to look like they're minuscule. It could be point something instead of 1, 2, 3. It's good. So and I'll go ahead. I'm getting ahead of you a little bit, but I just wanted to kind of parrot Ray. This is dramatic, and so for those of you out there that are thinking, "Oh my gosh, I don't really need to know about this," yes, your CPA will help you do all of the technical stuff, but wow, this is a major shock to people who are not used to thinking about what their long range obligations are. It's a major shock. So with that, I'll let you.
That's a great introduction to a very important point, and that is, in the past you would go to your CPA firm and they would handle it for you. You could delegate it. If your CPA firm is doing your audit or your review, your financial review, they are prohibited from helping you.
What?
Because they would be auditing their own work.
Oh my goodness.
This is a big deal in accounting. And so when you try to get help from your CPA, a lot of times number one, they can't because of this independence factor that's really important to auditing. But also they don't have the time because they're busy with other stuff. And this is a significant challenge to do from a technical standpoint as well as a software standpoint. And you're pretty much left on your own and you need help. And so you need to call somebody who can help you. And I think this is a great role for part-time CFOs, that they can jump in and help, because CFOs are typically CPAs that have CFO experience, and they understand the accounting pronouncements, which is not an easy thing to really be knowledgeable of.
Yeah, right.
And most controllers that operate in companies, they're not even aware of this situation, this new reporting standard. So, and they don't have the expertise. That it's going to take a lot of education to do this. As we have talked privately, I have probably 500 hours of reading and going to classes and working on one client in particular to get them compliable with this new standard. So that's a big change. So you better find somebody who can help you to pull this off, and maybe your CPA can give you some references of other people that can help. But most likely, they're not going to be the ones that are driving this. So anyway, I wanted to talk a little bit about the entry. So you kind of, I don't want to bore you too much on this, but this is really what it comes down to. If you have a 3-year lease and it adds up to be $335,000 of total lease payments over 3 years, you're going to have to book a liability present value of those payments of $300,000. And once again, you're getting into present value calculations by year. It gets very, very sophisticated and very, very complicated.
Right.
And you can see the entry. I mean, this entry seems very simple. It shows you the lease cost. It shows you how much is going against the current liability, how much is taken, impacting your accumulated depreciation in cash. I'm telling you, I spent days on making sure I understand where these numbers came from. It's not logical norm based upon past experience. So anyway, this just gives you an idea of the complexity. And remember, most people have leases for their facilities that are more than 3 years.
So can I ask you a question about
Sure.
that top number? You've got the 2022 number, estimated payment of $100,000. Yet, even though we're in the current year, the present value is $83,000. Is that because we have paid for January, February, or something like that, or is that more a standard present value of money calculation?
It's a value. It's a standard money calculation. Absolutely.
Okay.
Yeah.
And so that because that's lower, that normally has to take inflation into account. Is that, am I remembering that correctly?
You have an imputed interest rate. And by the way, there's 3 different interest rates that they recommend.
Yeah.
The first one is the interest rate that the lessor is using on the deal, which is almost impossible to determine because no one's going to give you that information. So, and then the second way of valuing the interest rate is you have to go to the banker, and for a collateralized loan, what would the interest rate be for that type of purchase? And the fourth one would be using some type of government security calculation, which would be a very low interest rate. But it gets, I mean, just on the interest rate, you could take days on trying to figure that out.
Right. And so the interest rate, is that going to reflect inflation?
Yes, it is.
Because now you in a lease you don't have inflation because you've got a standard payment unless the lease has an inflationary increase built in. Now I haven't seen one of those literally for 40 years. But
Usually,
you can believe I used to sign leases that had
leases usually go up by the CPI, and
Yeah.
the CPI is going up significantly. So
right.
it's going to have an impact on the amount of
Okay,
money
so
that-
normally that's in there. So yeah, this is pretty dramatic, and it seems as though even though you're trying to get very precise about those numbers, you're still kind of an estimation here. It looks like as to what it's going to be, but it's going to be a closer picture of your total requirements of your future expenses than what we have right now.
Yes.
Yeah.
So
Wow.
moving on, I didn't want to get too much into the example. I just wanted,
Yeah.
reason why I'm showing the example, just to show the complexity of this process, of this new standard.
Well, that was accomplished. You did that.
Yeah, and I think people look at this, they're going to say they need help.
Yeah, I think so. I'm already needing help. So,
So there are many challenges to this new lease reporting, and it shouldn't be a surprise, but it is. And Ron, and Ray, you guys have been in meetings where I've mentioned this to the CEO and the owners of the company, and it's a big surprise. And why are they picking on us? And
yeah,
it's just one of those things that, because if you're an investor and you're looking at a company to purchase, or you're looking at stock to purchase, you really need to know what these liabilities are. And so then you get into, well, the controllers that they're using at the company, they're not CFO types, they're controllers, and they don't have the knowledge of GAAP requirements that are necessary, especially if some significant change like this. So there's a lack of planning. For my clients, I've been working with their banks for the last 2 years, talking about how this is going to impact the covenants. And so there's discussion, and people understand that you know what's going on and you're planning for it. But if you go to your banker and all of a sudden this thing pops up, your debt to equity ratio is outside the norms of the covenants.
right.
That means you got to renegotiate. And every time you renegotiate, guess what? Especially if you renegotiate on a surprise basis, it could hurt your interest rate.
That's right. And the banks will use that to their advantage.
Yeah, so that is another challenge in this whole thing. So yeah, the banks on how they're going to react. So the good customers are going to do everything that they can to appease them. However, if there are any marginal customers that they're doing business with, they want to get rid of, there's a possibility here that they could be a little bit tougher on the renegotiation.
Yeah, you bet. You bet.
So to do this new requirement, you need the knowledge. You need the knowledge of a CPA and a CFO to implement. You need software, somewhere in the neighborhood between 2,000 and 10,000 annually to keep track of all these leases. Some people are going to try to keep track of them with Excel spreadsheets. They're soon going to be overwhelmed. They're not going to be able to do a very good job. They're going to have to convert to some type of software. That's another thing that small business owners should do right off the bat. Don't try to do it on Excel. Get a software package that can do it. And there's a significant amount of training required. And so think about it. You got 30 more leases you have to account for in all this detail. And these leases change. The terms of leases can change, and you got to have a system to account for all that. And it's going to add a large liability to your balance sheet, which we've talked about. And probably you don't have anybody on board that can do this accounting. Number one, they're not trained to do it. And number two, they're so busy now trying to keep up with everything else, they don't have the time to do this.
Right.
So you're going to have to make an investment as a business owner to upgrade your accounting department so that you can handle this new reporting requirement. And as we talked about earlier, you can't delegate it necessarily to your CPA firm if they're engaged in the audit or the review. And quite frankly, I'm not sure how many of them really are on top of this. They will be, and they're going to be the ultimate record keeper, and they do a very, very good job of complying with GAAP. But it all comes down to timing and how important you are. And if you're a small company, you might not get the attention that you need to really pull this off.
Ed, this is a point of reference here. I think what I'm hearing you say is that having access to someone like you who's an expert in this, makes a lot of sense for a small company rather than, investing in all this internally. Is that accurate?
I think so. I have a contact with a CPA who's part of one of the top 10 CPA firms in the country. And he's trying to help his clients out by talking to them and telling them what to do. but he said that he would really like to be able to utilize me because I can actually do the accounting for
Right.
his clients, and then he can come in and do the auditing and be independent. So I think this may force some CPA firms to work with other CPAs to get this done. And so that'll be a big change from the past.
Mhm.
But if you're a small company, you need to move forward, and you can't wait till the last minute. You got to get moving on this as soon as possible. And this isn't something that is easy to understand. You're not going to go to an 8-hour class and come back and be able to implement this. This is pretty complicated.
Wow.
Thank you.
And also, we talked about how it impacts the balance sheet. I think it's going to change future transactions because people are going to, owners of company are going to say, well, there's so much work to these leases to account for, and why don't we just buy the equipment or whatever that we're looking at rather than leasing it?
Yeah, I was going to kind of bring that up, and you got it right there. It seems as though the complexity is just almost out of hand, and so many companies will just simply throw up their hands and ignore it because they won't understand what to do, and they're just going to resist it and say, this is another one of those bureaucratic kind of rules that has no foundation in logic or rationale. Now, I'm not sure that's actually true. I'm just saying that that's what the small business person is going to see it as, is just another way to kind of get in your face. And when you make it really complicated and the CPA can't handle it for them, they're going to throw up their hands. And when you get there, I'm real interested in the enforcement aspect of this.
The other way some people are trying to deal with it is that they're trying to be smart about it. They're trying to say, okay, I'm going to change my leases to month to month.
Mm-hmm.
Guess what? I had one person try to do that, and I had to come back and say, you can't do it because you have no plans to move out of your facility. You've been in your facility for 20 some years.
Oh, yeah.
We can't do that. So we have to have a justification saying, okay, we're going to be looking at a new place maybe in the next 3 years. And then we would put it on the balance sheet for 3 years. But most likely when I went to the experts in the subject, they said 10 years, most likely. If you've been in a facility for 20 years and you're looking in the future, you probably should put it on the balance sheet for 10 years worth of liabilities. That's a big liability.
Well, you bet it is.
Get around it. So fractional CFOs can be helpful in this area. We talked about renegotiating bank covenants, which will require some help from somebody to help work with the bank on this. And it basically protects the investors and will increase the cost of accounting for most small businesses.
Hey, Ed, have you found in working with banks that they're at all familiar with this, or is it kind of blindsiding them as well?
Well, a lot of bankers 2 years ago didn't know about it, but I think over the last year, over 2021, they become knowledgeable that this thing was coming up. And but trust me, it's going to be a surprise. Someone's going to turn in their covenants, and if they report it the right way, they're going to have a problem with the bank, and they're going to have to renegotiate their contract or present it a different way so that they comply with their covenants. Bank covenants are really important, guys. Yeah. You have to meet these requirements. It's a way for the banks to limit their risk. And if you violate a bank covenant without planning for it in advance and letting them know, it's a big deal.
Yeah.
So
can you give us some idea of the consequences if that, if you violate? I mean, do you lose loan? What happens?
Well, they can say to you that we're not going to give you this line of credit any longer, or
right.
That would be the worst case, obviously, or we're going to increase the cost of that line of credit. we're aware of a company where the bank asked the line of credit to be paid off during the year and restarted.
Wow.
These put undue hardships on companies
Right.
Yeah.
who need that money. And I always say one of the biggest responsibilities you have as a business owner is making sure you have the money when you need it to operate. And that means you got to plan in advance. You got to ask for money when you don't need it. And you have to comply with the requirements so that you don't stick out as an exception. So that banking relationship is extremely important. It's not usually something a controller handles. It's usually, again, what a CFO does for a company. That's one of the big relationships that you nurture and you work on and you communicate. You talk to your banker on a monthly basis, letting them know what's going on. And when you have a problem and under that type of a situation, they're all there to help you. They just don't want to be surprised. Just
Right.
like we don't want to be surprised, or business owners don't want to be surprised. And unfortunately, if you're relying upon a controller that's not complying with GAAP requirements, this could be a surprise. And it could be a
Well,
negative
and
company.
of course, just to kind of keep this in perspective, when we're talking about small companies, the average small company does not have a CFO, doesn't even have an accountant. They've got a bookkeeper. Now, they may call them one of those things,
Right.
but they're a bookkeeper. And that bookkeeper's, job is to kind of do what they do and, put numbers in certain boxes and categories and that kind of thing. So they're really not going to be equipped to do this. They may try to do that, but we're talking about, I'm going to say 85 to 90% of small businesses don't even have anybody to do this, and they won't even find out about it. So the pushback is not even going to be pushback. It's going to be abject ignorance, and people are not going to do this. That's my initial reaction is that the average small business will not do it, and I wonder if they need to. So
Well, I think
I'd like you to kind of address the issue of why in the world would you say start with say public companies, but then force this down all the way to the bottom to the smallest business. I mean, is that where we're at? There, you would think that there must be some starting point at $2 million, or $3 million, or $4 million a year, or something like that. But if this is really true for any business, this is an unrealistic request, not request, demand.
There's a lot of small businesses that are on a cash basis.
Yeah. And so are you saying that if you're on a cash basis, then you do not have to do this?
Well, yeah, you wouldn't have to do this, but if you want to go to a banker and get a line of credit from the bank, they're going to want to know about these liabilities.
Yeah. So I can really see it changing the complexion of borrowing for small business. It opens up an opportunity for private investors, and even in some under the table bankers, the sort of the guy on the street kind of thing, because they're just simply not going to be able to handle this, especially if it's somebody who's got, say, a long-term lease on a very small building, even a storage space. And how are they going to deal with that? And they might need $15,000 or $20,000 or $30,000 operating capital that maybe they pay off every year. So they don't need a lot of money, and they're going to look at this and go, I just don't think I can afford to do this when I'm only borrowing $15,000 or $20,000.
Well, if you are self-sufficient, you're a small company, and you're not interested in transferring your company to a new owner, you don't need to do this. You can remain on the cash basis of accounting. Mm-hmm. But one of the things that we've been talking about in this series of conversations is getting companies ready to be sold.
Yes.
Right.
Passed on to the next generation.
Yeah.
And one of the things we recommend is that they have good financial statements that are prepared in accordance with GAAP. And if they're large enough, we would like to have those companies audited, because when people look to buy a company, they want to see generally accepted accounting principles, financial statements.
Right.
Right.
That protects them to make sure that they're looking at all the obligations of the company,
Yeah.
all the assets.
Yeah. Yeah. And that, I was having a conversation with a small businessman, but a very successful one, who probably makes $150,000 a year. And I was suggesting, as we talk about so much in this group, well, what about bringing in a younger person and training them and having them buy and take over and so forth? So as we talked about it a little bit, his comment was, it's not worth it. So what if I get 2 or 3 times the multiple? If I could find someone that would eventually pay me $300,000 or $400,000 for it, it's not worth the effort. I've already got my money. I've been making $150,000 a year for a long time. I don't need the hassle. And so you can see where a lot of the headstrong, successful, independent business people will just thumb their nose at this idea and simply say, it ain't worth 200,000 or 300,000 more dollars in the price. So forget it.
Yeah, I agree, Ron. And the statistics are pretty interesting in terms of us as baby boomers. 80% of us are simply going to close our doors.
Yeah, we know. You're right. You said that before, and we know that's going to happen.
Right.
Now it's going to happen. They're going to close it a little faster if they see that they're going to have to do all of this stuff, right?
Well,
This is to me, it's a real problem. Just trying to get a business to pass from one generation to the next.
Right, but I think that the point that we're trying to do is we work together here to help companies. I mean, we're focused on that 20% that really have a need to be able to transfer to another generation or to another owner. So that 80% is really not relevant to us, and they don't have to do this, I don't think. Is that fair, Ed? The people that we're really trying to help are those who intend to, move the business on to another generation or to a new owner.
This is an interesting subject, and we could probably spend a whole program on this. I have a hard time understanding. I know there's people like this. I know somebody who was a very profitable jeweler that had a very profitable business and decided just when he retired just to shut it down.
Mm-hmm.
He could have sold it for $1 million.
Mm-hmm.
I'm not sure I understand that logic. I guess I have to refer to you, Ron, because you seem to understand it better than me. I don't know why you would leave money on the table in a situation like that.
Well, it has to do with the mentality of small businessmen. And we're talking about more than 80%, 90, 95% of small businesses that say do less than $2-3 million a year. Their attitude when they got into business was, I want to control my own life. I want to be independent. I want to do work for myself. I want to get rid of my boss. So you see, you're making an assumption that their attitude is monetary and driven by money. That's not why they're in business. Yes, they want to make a living, and yes, they get to the point to where they'd like to make a nice living, but they are not really very often switched over into this, I'm going to get rich and I'm going to squeeze every dime out of the business possible. That's not why they're in business. Yeah. And that's not their motivation. And so when you make it, as advantageous as it would be for individual people, for the economy as a whole, for the whole country, to be able to transfer these businesses, that's not their motivation, and they're just not going to put up with it. So
well, let me bring up this.
Yeah.
Let me bring up one more aspect, and then we can kind of terminate.
Yeah, go ahead.
Program, sure. And that is this. I have a client that we've been working on a succession plan, but we've never really completed it. It's like, we start and then it gets postponed, and Well, what ends up happening, it's an engineering company, and the success of the company is based upon their employees. Their key employer, the key employee last year resigned and took a job with a bigger company. And it wasn't because of his pay. It had nothing to do with the work. He enjoyed working there. He said to the owner, "You have no succession plan in effect. That means if something happens to you, I don't have a job. I'm 35 right now. If 5 years from now or 10 years from now, when I'm older, I may not be able to command a comparable job outside of this company. So therefore, if you also have to think not only the money, you have to think about the employees."
Yeah.
And that was a perfect example. It hit home. I mean, and the owner scratching his head. I mean, why is this guy leaving? This guy's a key guy to our company. He's treated well. We paid him well. We want him to be an owner eventually. But you know what? The guy doesn't want to be an owner. He wants to be an employee, and he wants to have a runway for his career.
Right.
That so when he's 65, he can retire and have enough money to retire without having to go through a bumpy rehire situation with a new company.
Yeah.
Yeah.
And that brings up another aspect of small business owners. They're independent. They want to be independent. The person, especially an engineer, who's working for somebody else, is not that person. That's not who they are.
Right.
I mean, there are exceptions to that. There are definitely exceptions to that. But that's part of the reason why it's so hard to bring somebody in who's going to come in and take over the company, because they didn't have the personality to take the company over to start with. They had the personality to come into work every day, do a good job, pay attention to the details for the owner, and then they wanted to go home and be able to sleep at night. The independent business owner doesn't care if he sleeps at night. He's got lots of energy. He's going to be a kick-ass kind of person, or she, and it's like, well, why would I work for anybody else? That's crazy. So you see, the problem here is that the worker doesn't have the attitude of the owner.
Well, and I think that's a good point, and it's also one of the things that makes the transition so difficult.
You bet.
Because basically, as Ed just pointed out, the guy says, I don't feel comfortable here. I'm going to go someplace where I am, and thereby, diluting the value of the client company.
Oh, well, yeah, of course. And of course, he's using a lot of leverage there. Now, the owner should have realized, because if he's like most owners, he cares about his employees very deeply. And he should have been smart enough to realize that I'm going to need to put this succession plan in place because I care about my employees.
That's,
And the ESOP program that we did kind of points to that. There are reasons why owners would do that, but it's not about money very often. I mean, that's sort of like icing on the cake. It's really, I'd like to leave this company as a legacy, as Ray, you bring up from time to time, or because I would like to provide a place, for my employees, or
Yeah.
I don't want to stop doing what we do so well for our clients. It's just good for everybody, the community, et cetera, if I do this right. I mean, that's almost a social obligation. It's not about making the extra 200.
Yeah, it's and I think one of the things that this illustrates, and again, it's what we're trying to reach is that 20% that want to move on to the next level and move their business. But it's like you pointed out, the independent businessman, that's the furthest thing from his mind. He doesn't think about succession planning. I mean, we have not found, at least in my mind, companies that we've worked with really don't have a good succession plan.
No, hard. Very few.
It's like it's the furthest thing from their mind. It's kind of
That's
like,
right.
I got to function and be able to make it day to day. Who's got time to think about who's going to take over the company?
Well, they're spending 12 hours a day keeping their business going, so that
exactly. Yeah.
So so it's sort of like, well, that's at the end of my list. I'm sorry. And frankly, people who haven't been there, they don't understand that.
No, and I was gonna say, if he's only working 12 hours, he's a part-timer for most of us who are independents, you know?
Yeah.
There are, I mean, just to summarize it, there are businesses that are going to just shut down.
Yeah.
They don't have the appetite for their business to survive, like Ron said. Totally get it. There's a lot of businesses also that think they're going to sell their company at a high price. They all have a price in mind.
Right.
They have no succession plan to reach that price.
Right.
So they're going to be extremely disappointed because their business is going to be sold for pennies on the dollar.
Right.
But it does bring up a very good point, and it's something I have a hard time relating to, but there are a lot of people out there that will just shut their business down. I get it. I don't agree with it. I would love to be able to buy those businesses. I'd love to have a business to buy those businesses and carry on them on and sell them at a higher price for the owners that don't care.
Yeah.
That
Well,
would be
and part of that is when you're in that role, and you might be in the process of winding down and shutting down. It can get to be so tough and so hard to actually do the wind down, and still trying to take care of customers as you're doing some of that stuff. It, it's such an emotional drain. And it's almost like companies that go bankrupt. And I haven't had a lot of clients over the years that have gone bankrupt, but of the ones who have, usually I haven't been engaged with them for several years when that happens. But when you follow up with them, you find out they are emotionally so distraught that they can't make good decisions anymore by the time they get to that point.
Yeah.
So, if you're thinking you'd like to shut down and you've been working for 15 years, 20 years, 12 hours a day or longer, and you finally get to that point to where you just don't want to deal with it anymore. It is really totally an emotionally driven decision. And so there's no logic to it, Ed. It's just like, no, they just want out. They want to be done. And that's kind of why that happens, I think. Now, by the same token, it provides an opportunity for those who want to get into business, a real opportunity to grab a hold of a going concern, if they've got the skill level to do it. And the question is, and of course, this is where you've been for a long time, Ray, is how do we find those people and match them up with these businesses that are beginning? Yeah. How do we do that?
And that's I really appreciate this, Ed, because I think it illustrates for us. One thing is that we know that the market that we're looking for is a small segment of all those people out there. But more importantly, that connection, that ability to be able to take, as an example, Ron, one of your micro giants and connect them with that jeweler and say, rather than close your doors, how about moving this forward? That to me is something that not only helps us personally, but helps the economy as well. When we take these businesses, instead of, just flushing them, move them on to somebody else who has this huge desire to be able to do something and perhaps the aptitude and capacity besides.
Yeah. Now, I would take that maybe a little bit different direction. The average micro giant person of interest, micro giant, is not really in that what you could said the 20%. And this program is not going to be for them necessarily. There are a couple of them that might be the case. However, I really see this as a major strategic planning shift here. If you're a small business, and Microgiants is about small, it's about startup. It's not about that the 20% that you mentioned. Microgiants is like where can you find a business with a good market niche that you can operate without all of the headaches in the world. And this is telling me, and I'm going to begin to completely rethink this, because I think, as I mentioned, this is dramatic, Ed, that you brought forward. It's dramatic because if I were going to start a business, another business, again, an eighth business, I would never start one where I had to do this.
I agree.
Unless I was going to go the big route, bring in $1 million of capital, and do something serious where I could afford to do this. But as a person who's just trying to build a little business, I ran into a wonderful lady from Peru the other day who has this very successful cleaning business. She's got 25 employees. She's doing very, very well, getting like double the normal fee because
That's unbelievable. Yeah.
she specializes in cleaning houses for realtors who are getting ready to stage homes.
Yep.
Oh, cool. Yeah.
Niche,
I probably just used her.
deep niche. She has teams all over Southern California. Just a wonderful person. And so here's a case where she doesn't need this. As she runs that cash operation, she has employee issues to be sure, but she doesn't need to have a lease. She doesn't need to have equipment. She's going to do everything cash because that's what she understands. And so you see, when you're a small business trying to make it, and you've only got several $1,000s to invest, you have to find a business that's not going to have this kind of requirement, which means watch out for equipment leases, watch out for a whole lot of real estate leases. And that drives you back to digital again. If you remember the program we did, what are the best businesses to start in the 2020s? This sort of eliminates, for a small business person who doesn't want to grow over 2, 3, 4, 5 employees, this eliminates the entire idea of leasing anything. This makes it a truly a cash business. And it also says to me, small business people have to become even more conservative. They need to be buying things for cash, not relying on banks. And there are large communities in Southern California and around the country, perhaps more here, where that's just their ethic and their attitude. They don't want to deal with the financial community. They have to deal with a tax preparer, but they don't want to. And that's so when we talk about where the business is, that is a growing aspect of businesses and of the new businesses. And by the way, I just wrote an article on how many new businesses we've had. It's at an all-time record here in the last 6 months. That of those new business, I would be willing to say that 95% of them fit in that category. So that's where the market's going as far as business startups.
And as we have talked about many times, and Ray has alluded to in this program, the opportunity is to be able to find those types of businesses and work with the ownership on transferring it so the business continues to the next generation, right, and they get some type of a reward for doing so.
Right.
And
now, fortunately, yeah, I'm sorry.
They have to hand it off to people that are capable of doing this.
Exactly. And I think fortunately for those who have listened to this and they're in regular business, they're already in manufacturing, they're already in some kind of a situation where they have, say, restaurant leases. This is you are a terrific resource for them. Yep. And that's really, I think that's the only solution I see here, is that you have to rely on some outside people. And there are a whole lot of businesses that don't, they're very skeptical about doing that. And so I would suggest that those small business people need to network with each other, micro giants or other groups, and try and find good people that can help them part-time solve some of these problems, because they're going to have to deal with it.
Right.
Excluding leases from this whole conversation at the end here, finding these businesses is a real opportunity, and taking them to the next level, to me, without the owner. If the owner doesn't want to be part of it, fine.
Yeah.
But to be able to continue those businesses into the future somehow, utilizing some type of consulting group, that right now there aren't any groups out there that take care of these types of businesses that I'm aware of. Where do they go?
Yeah.
No, they're out there, but they're difficult to find. If
Well,
you're
I
a
think
small
the
business
value
person,
of what
yeah.
we've been trying to do, this is not only just a social issue or an economic issue. This is about our economy as a whole, and how do we preserve those businesses and move that forward. You know, I think that's the issue that we've talked about before, Ron. You know, and I know Ed, you've mentioned it. You know, how do we make those connections?
Yeah.
And enable people to bring in somebody who can create that succession for the company.
Yeah, it's a huge challenge, and the unfortunate trend here is that as regulations continue to build up like this, the people who are doing the regulators are not in the position to know. They do not run businesses. They are many times guilds that make these decisions. In other words, they're professional organizations that have state licensing requirements, and they're the ones who are deciding how your electrical outlet is going to be done, right? Whether or not it's safer or not really is not what's happening here. And so, I can see the benefit for this particular regulation we've been talking about, but as we continue to regulate, we will continue to make it harder to form new businesses, and particularly harder for them to grow into bigger businesses. And one of the things that is not often mentioned is, number one, look at how important small business is, because half of us work for small businesses. Right. What we don't often realize is that the statistics are very clear. The ones that add a lot of employees are the ones who grow very rapidly. They're not the thousands of new businesses that start. They don't hire lots of people. It's the ones that end up are headed towards going public. They're the ones who are still small businesses but are hiring people. They're the ones who are impacted by this.
Right.
Yeah,
well,
and that's a very sad thing for our economy, and you just wonder how long we can go like this.
No, I think there's some merit to that, and I think one of the values of what we do is that we are trying to expose people who are interested in learning, understanding, you know, some of the good things that have to be done. And this, as an example, Ed, has been very, very powerful in helping people understand if they want to make that transition, and some of them do, Ron. You know, we provide them with information that enables them to avoid some of the pitfalls that other companies don't. And to Ed's point, you know, it's really sad to see somebody with $1 million business simply say, I'm going to close the door, when we've got all these young people who are looking desperately for an opportunity like that.
Yeah,
so
that's right.
Having said that, thank you again, gentlemen. This was wonderful. Appreciate it. And with that, I want to bid adieu for another session of the Three Consulting Amigos.
Right. Thanks, Ray. Thank you, Ed.
Thanks, guys.